Let's bring in Steve Sutmeyer. He's with Bank of America, their chief equity technician. It's good to see you, Steve. And yeah, I mean, no one really wants to be that bullish right now, or maybe they do. And I don't know, but you know what I mean? No one's that excited, I think, about the summer. So what do you see in the charts here?
Yeah, sure. Thanks for having me on, Kelly. I think we have a lot of stability for equities. In our last note, we highlighted that the S&P 500 was trending above its 40-week moving average, which has only started to rise after defending and testing a 200-week moving average last October. So we continue to view the longer-term trend as secularly bullish. And if we continue to build this base that the market's in now and spend more time above the 40-week moving average, that would argue that cyclically the market could be shifting better also.
What do you see in when as you watch the 10-year and kind of overlay that with what might be happening going forward in equities?
Sure. I mean, I think when you look at, we like looking at the spiders versus TLT ratio. And we think that the S&P and stocks are set up to outperform bonds. They actually did outperform bonds. The S&P actually outperformed bonds all last year. So bonds went down, stocks went down, but stocks outperformed. Right here, right now, we're still in an uptrend for the stocks versus bond ratio and consolidating within a technical pattern called a triangle. When you're in an uptrend and trading in a triangle, you usually resolve higher from that pattern, which means that stocks should have another up leg relative to bonds.
You know, when I think about what you're saying, I go, okay, but if the charts are right, they're telling us we're not going to have a debt ceiling fight. And wouldn't that be nice? But you know what I mean? There's no way we're going to have a debt ceiling fight and have equities going higher, right?
I mean, look, we last time we had a debt crisis with the ceiling, I believe it was like 2011, and the market struggled a little bit, but worked its way higher after that. And it defended moving averages as support, such as the 40-week. So I think we have the turn in trend. And if we're worried about, sell in May and go away, a lot of folks are talking about that. The seasonal pattern does actually suggest that you sell April, you buy back any downside volatility in May, because there is a tendency to get a summer rally. When we look at 3-month seasonality, for instance, June through August is the second best 3-month period of the year. So you tend to get a summer rally. So the real saying should not be sell in May and go away. It should be buy May, sell July and August, because we all know what happens after August. You move into the fall, where deeper corrections become more likely for equities in terms of seasonality.
And you think even this year there's no reason to question that. So, not to do the 2008 comparison, but we had a similar period of quietness and strength kind of late spring, summer, and September was obviously a very different story. So you're not saying that we might, hold on and continue to be that strong.
No, I think we should. I use moving averages as a guide, and in 2008, the S&P was not above its rising 40-week moving average. In fact, it was falling below a declining 40-week moving average. And in 2008, the S&P had embarked on a trend below its 200-week moving average. So you can make a case that in 2008, you were in a secular bear market. Here at this point, as long as we're above the 200-week moving average on the S&P, we are still in a longer-term uptrend. And the interruption of that was cyclical in nature, not secular.
No, so I appreciate it. Actually, I'm glad I asked the question because that's very interesting. Steve, thanks for your time today.